In this video, I'll discuss the three options you have to own property in your personal name, a company, or a trust. So why is this important? Because each option has different tax implications which vary depending on the purpose of the property purchase, whether it be rented out, on-sold, or if you plan to live in the property yourself. The entity which owns the property could either cost you or save you thousands in taxes. It is fairly simple to change property ownership from one entity to another, but this constitutes a sale which attracts transfer duties of up to 10% of the total value of the property, which makes it a costly exercise. So, it is crucial that you select the correct entity to own the property from the outset. Whether you're a first-time buyer or a seasoned investor, or just looking to learn more about property ownership, this video is for you. In the first scenario, the property is owned in your personal name. Now, if you live in the property, it's considered to be your primary residence. This is good news from a tax perspective, as the first $2 million of the profit you make on the sale is exempt from capital gains tax. However, this exemption does not apply to second properties you own in your personal name, as they are deemed to be investment properties and will be taxed at 18% CGT when you sell it. This is still less than 22% CGT if the property is held by a company. Another important tax consideration for homeowners is tax deductibility of bond interest. If you live in the property, the bond interest is not tax deductible. But if you choose to rent out your own investment property, you are able to deduct bond interest as well as other costs such as insurance, rental agent fees, and rates as expenses. Now, the net rental income is then added to your personal income, salary included, and taxed at your marginal tax rate. It's a good idea to ascertain which ownership entity is more tax efficient, your personal capacity or a company. Now, given these considerations, if you own only one property, which is your primary residence, it may be beneficial to register the property in your personal name to take advantage of the $2 million CGT exemption when you sell the property. The second scenario is to own the property in a company. The first benefit is that of limited liability, which means that your assets are separated from your personal liabilities. This protects the property from unforeseen financial events such as insolvency, as the property cannot be attached by the courts as it is held in a separate legal entity and not in your personal capacity. However, if you have signed personal surety or if you are the shareholder of the company owning the property, this protection falls away. This is where the company shareholding of a trust can play a role, but more on this later. Now, if the company is VAT registered, you can claim back transfer fees for commercial, industrial, and short-term rental properties, but not residential properties. Additionally, if the property is newly built and bought from a VAT-registered developer, there is no transfer duties, as by law it must be included in the purchase price. However, there will still be conveyancing, bond registration fees, and occupational rent. I must mention that when buying a property from a VAT-registered developer, the transfer fee exemption applies to all three forms of ownership. Now, there are other tax incentives specifically for companies, such as Section 13(6) and the Urban Development Zone, which are designed to encourage investment in new property developments. These can be very beneficial from the investor's perspective, as it can increase the return on investment by 3.5%. Or put another way, over a 10-year period, 55% of the value of the property is exempt from taxable income, which effectively means that you get 23% of the property for free. But these benefits only apply if you meet the criteria and the property is held in a company. So more sophisticated investors who take long-term views structure their property portfolio in such a way that their company owns the properties and the shareholding of the company is held by a trust. This structure ensures that the properties are not part of the individual's estate, which can be beneficial from an estate planning perspective, as it does not attract so-called inheritance tax. The downside is that these structures are more costly to maintain, especially in terms of accounting fees, There's a further complexity to property ownership in the company which relates to getting the money out of the company and into your name. This can be done in one of four ways, namely loan accounts, dividends, salaries, or a combination of the three. This is vital information every business owner must understand. I've made a separate video on this topic, link in the description. The alternative is to keep the profits in the company and continue to purchase more properties. Once you have reached this level of investing, tax efficiency plays a greater role in your investment strategy. Assuming you are fortunate enough to own multiple properties, it can be hugely beneficial to own them all in the same company. You can now push all related expenses through the business, which in turn lowers the tax liability. In addition to the previously mentioned tax incentives, the company may also qualify for the small business tax incentive, provided you meet the SARS criteria and the properties are not residential in nature. So, if you're looking for a tax-efficient way to own multiple investment properties, the company option may be worth considering. The last option for owning property is in a trust. However, this option comes with several disadvantages. Firstly, the CGT rate is the highest for trusts at 36%. Additionally, income tax is also higher for trusts at 45%. Now, governments worldwide, including South Africa, are continuously legislating against trusts. For example, Section 7C legislation was introduced to prevent estate duty avoidance in trusts. Now, owing to increasingly onerous tax burdens, owning property in a trust may not be the best option. However, a trust can still play an important role as the shareholder of the company where the company owns the property and the trust owns the company's shares. In this instance, the small business tax incentive is forfeited. In summary, owning a property directly in a trust is not recommended due to the high CGT and income tax rates, as well as the continuously changing legislative landscape and increasingly onerous tax burden environment. Instead, consider one of the other ownership options discussed earlier. Please consult your accountant or tax advisor before you purchase the property to help you decide on the correct entity for your needs. I hope you found this video interesting. So as always, remember, we are here to help.